All right. Good morning, everybody. So as we usually do, I want to start out taking a look at what is going on around the world, kind of get a feel or an idea for what was happening while you're asleep. I've got a lot of paid programs and, subscriptions to different services, and I try not to use those sort of resources in this morning briefing since it's an educational piece. I'm trying to give you guys the tools and the ideas and the ways that you can perform this for yourself without having to spend a lot of money and have a lot of subscriptions, right? You should be able to do things without having to pay out the nose for a bunch of stuff. One thing that can help you in your morning briefing is using the FinViz futures. I'm not logged in. I don't, I'm not on I'm not on my account, but you can see what's going on in the markets around the world from this tab, right? So we talk about looking at the Asian markets, keeping an eye on what's going on. Europe is still open. Asia's already closed, but we need to get an idea of what was doing good in their market, what sectors, what industry was doing good, what was doing bad, what kind of news was going on. Were they even open at all? Right? Different countries have different holidays. So if you want to add something to your morning routine, rather than just using Finance Juice, you could go over to FinViz and without signing in, with no account at all, just go to futures. It might be a little delayed, 10 or 15 minutes, but it's not going to hurt anything. You're doing an analysis of what happened in the overnight hours on a market that's already closed, right? Like Asia's closed already. It doesn't matter if the data is delayed. I'm going to hit the pause here just a second. Oh, sorry about that. I almost sneezed in everybody's ears. You'd have heard that. All right. So another thing about yesterday, there's already been some feedback that the move was not what Powell wanted to see. And I get it, right? He's trying to perform wealth destruction, and the market made one of its biggest 1-month moves in like years. So the 3% move, that's just one more 3% move that we've had this year. And it's not the first one we've had. There's a lot of Fed speakers on the docket today. We might hear from any of those to kind of tamp down this over enthusiastic move to the upside. Just keep in mind, we have inflation data coming out today. And if it's reduced inflation data, and that's not what they're expecting, they expect it to be, this is the PCE deflator that I'm talking about. It's an inflation metric, and they're expecting it to be a little higher, like a moderate rise between year on year for September. If it's not a moderate rise and instead it's down, adding to the fire, the market's going to just continue to rip. Upcoming in the next week, 2 weeks, we've got a lot of econ on deck. But before FOMC, even if it's just one day, we have CPI, we have PPI coming up. And if these metrics show that they are reducing inflation, or that inflation is decreasing, That'll be 2 months or 2 readings, 2 CPI, 2 PPI readings in a back-to-back showing a decline or a decrease in inflation. And if you thought the RIP rally was strong coming off of that October, November low in the market, then it's the old song, you ain't seen nothing yet, right? That just really aggressive rally. The market is still trying to focus on looking down the road, even if it's 2023, at the end of 2023, and when the Fed will stop hiking. They're not even looking at the recession part of it. They're just looking at the end of it. And there is precedent, the 80s, 82, 83 recession. The market had already priced it in. I think it was the 82, 83. Either way, the PCE deflator today at 8:30, that's a big deal. And if it's positive in any way whatsoever, it's going to add right in with what Powell did yesterday. And we're very likely going to see a continuation of this spike higher. So we're talking about pricing things in. One week ago, a 50 basis point rate hike was a 75% probability. And a 75% chance of a 75 basis point rate hike was at a 24% chance. That was a week ago. And if you look at what we were at yesterday, we were at the same thing. So in the last week, any small gyration, any move up or any move down, we didn't get anywhere. Yesterday's move brought us 2 tiny percentage points up. So this went up 2 tiny percentage points, and that went down not even 1 percentage point, right? Some little bit of metrics. So that 50 basis points was already priced in. It wasn't new news. Let's say it that way, right? They weren't unwinding anything. There was no big surprise to the market. It had already priced in that we were going to do a 75 basis point rate hike, or we were going to do a 50 basis point rate hike. What we want to be watching for now is the February 1 FOMC. It's very likely that they're going to maintain this 50 for a little while. But we're still trying to get answers on where their target is. So we're at 375. If their target is, say, 5.25, how are we going to get to 5.25? 50 basis points would get us to 4.25. Another 50 would get us to 475. And then another 50 would get us to 5.25. So they can do it that way. And that would be 50 for December, 50 for February, 50 for March. But they could do 50 and then a bunch of 25s back to back, right? And kind of let it slow down that way. So we're likely to hear more about it at the FOMC. Be really cautious today of all these Fed speakers. Since the market made this big exaggerated move, and we're almost positive that's not what Powell wanted. They may be coming out here trying to tamp this market down and kill some of this enthusiasm. And, like I mentioned yesterday, they can move the market all they want. They don't have to buy anything. They don't have to sell anything. All they got to do is come out and talk. So PCE today and these Fed speakers, those are the two big ones. There is more talk about China reducing its COVID-0 restrictions. You do have to be careful about this. They've done a little wink and nod before and then pulled the rug out from underneath people. But it seems like they're trying to ease conditions on the idea that the COVID in their region is finally starting to become that lesser variant, right? Like there's the really strong, deadly version that came out at the beginning of all of this. And then as time went on, the variants got weaker and weaker and weaker, and also more contagious, right? And it just kind of spread around until everybody had some variant of it. So with China reducing that COVID-0 stance, it's what the entire world has been looking at, because China's the next, like 2023, everybody's looking at China for investing and possibilities of markets coming back up again. So definitely keep your eye on that one, and we'll see it when we go through the scanner. If emerging markets are up, if KWEB is up. All right, so we got just a real busy day. And we have additional auctions today. So you got to watch the clock through the lunchtime, 11 and 11:30. There's no 1 o'clock. And other than potential speakers in the afternoon, there's nothing on the docket. So you have the freedom for an afternoon 0-day play. You got Barr speaking at 2 o'clock, and that's the last one. Check that time zone so that you don't get my time zone mixed up with your time zone. Depending on which browser I use, sometimes it gives me East Coast and sometimes it gives me my own time zone. So don't use mine for a bar. All right, we've been talking about this range, this weekly range, and the idea that we needed to get out of it, and a solid breakout would give us the idea of where we're going to go for the rest of the year. The week isn't done yet, right? So, it's a weekly chart. The candle's not closed. This breakout from yesterday is not complete until the end of the week. We do have a gap to fill, very close to that 4,100. 4,110, it's a cog line, 4,111. When it comes to this rising wedge, there's a spot along the wedge where it's like 60 or 70% of the total wedge, where it finally just can't take it anymore. And that's where it breaks down. It very rarely goes all the way into the tip, right? So it's usually 60 is a little early, 85 is a little late. That's not a huge window, but call it about 70-75%. When you're through 75% of this rising wedge, that's generally where it breaks down. And like I've mentioned before, you can see like this squeeze breakout where you get a blow off top signal and then it dumps through the bottom. So we do want to focus on that gap close at 41.11. But everything is still going to be dependent on how the news comes out today. We can see the volumes right about where it should be. It's not below 100. It's not above 200. That's all we really need to see out of this thing. We just turn that off. It's been a pretty narrow range since last night, right? It's a real narrow IB. Started to shake and bake a little bit more, but not too much. Globex low is 40.72 and Globex high is 40.96. It's like a 25-point range. Pretty close to that. There's no real structural support underneath this market sitting at its current level. So if we were to start breaking down, there's nothing to catch it. There's no real volume nodes or anything like that. We took that VPOC off yesterday. You see how that was the one spot the market paused in that run, was at that old VPOC, which we don't need anymore. So we take that off. The previous week's high is now the pivot that we want to focus on. After making a really big move and breaking out of a resistance zone, we very often see price pull back and validate the old resistance as a new support. I call that a Busby, but it doesn't really matter what you call it. It matters that you recognize the potential for it. A pullback to the previous week's high would be healthy. It'd be good, right? So it's not a bad thing to see us kind of fade off after such a breakout. As long as we close on the week higher than 40.50, then we're going to continue to focus on the upside moves into the new year. What we want to do this morning is kind of play out the scenario of more really good news. The exuberant move that we had yesterday triggered some massive buying. There is something called a market on close, and you can filter it different ways. But if you filter the size of the market on close to only look at things bigger than, say, 50,000 shares, then you can kind of narrow down the names that are on that list. There were over, I believe it was 5-1 buying on the MOC yesterday. 2-1, little above 546 to 222. Right. And the metric that they are using, or the filter that they are using, is 50,000 shares. So the MOC needed to be bigger than that. But that is a massive number, especially if you look back over the last 5 days when we've been looking at, 150 here and 50 there, not really big numbers. And then this just big blowout number. There's a lot of funds out there that want to get into their darling names at a nice low price, looking at a 5 to 10 year horizon, right? They're not looking at getting in and out over the next month. They're looking at the bigger picture, a decade from now. And they like these prices. And they like that language out of Powell yesterday. So think about today being another one of those. Say the PCE data comes out today and is trending in the right direction and kind of confirms that all of this work that the Fed has been doing is actually accomplishing something on the battle against inflation. We're very likely going to see yet again another over exuberant move, way beyond what a market should do, into that really crazy fear and greed. I talked last week and the week before about how many of those firms are stuck in the FOMO mode. They missed the March lows of 2020. They missed that gigantic, massive rally, and they don't want to miss this one. And a lot of them were positioned for the big move, even though they've all been saying how bad it is out there and how dangerous it is and how we should all be looking down. Their money has been pointing to an upside move. Nobody wants to miss the swing. Looking at that market chameleon data with the market on close yesterday, it shows how much more aggressive the firms were willing to be and started jumping into everything. If this morning's data continues to show that the Fed is actually accomplishing their goals, the exuberant move that we're seeing is very likely going to continue. So we want to focus on another really big move, which puts us up to 41.72. And I said big move, but that's our measured move. So that wouldn't even be big, right? That would just be in line. 40.72. Or excuse me, 41.72 gets us right up to the top of this really big candle from September. So that's going to be a really big deal to focus on. As you can see, we're above every single major moving average, from the 10, the 20, the 50, the 200. We're above them all. It's the one thing we couldn't get done earlier in the year in that August rally. So at this point, there is no overhead resistance. There's only overhead magnets, gaps that need to be closed, and some overhead trend lines, some angled resistance, perhaps. That's it. So we want to be prepared for that kind of move today. But we also need to look at the other direction. If the data comes out in the other direction, and if the Fed speakers that are on the docket today want to help Powell try to tamp down this market. All they got to do is change the language, right? Come out more hawkish, and they can tip everything down. Add that with some, say, perhaps some bad data from the PCE. And we're looking at that point of getting back inside the box and aiming for the previous week's low today. So the ADR with the measured move, right, would put us at around 40.16. That's close enough to the COG line. We just say 40.11. And that's really close to the weekly pivot point. And like I've said before, the pivot point is not support, resistance, anything like that. It's just a milestone, a goalpost, something to look for. But if the normal move is 40.16, which is a 1.92% move, and we want to know what extreme looks like, take 1.9, cut it in half, and then add it to the 1.9. And that would be your measured move. Just use some rough numbers. Let's call that 120, a 120-point move. $39.70. So basically where we were yesterday as we were coming into the open, it would completely unwind that entire move. So that's within our boundaries. At the moment, we have a missed daily pivot. I always like pointing those out when we have one. It's not my strategy, but if you were to look around on the web, you'll find strategies for it. It's called an MDP, missed daily pivot. Markets hit their pivot more than 80% of the time. So on those rare times that you find a market has not hit its pivot, it matters. Like back here where we didn't hit the pivot, right? Or say back here where we didn't hit the pivot. All right, from the bottom of the box to the top of the box, as we talked about before, we're going to lose this Thursday's data. So by Friday morning when we come in, that'll be gone. And unless we break down today, the bottom of this 10-day, 30-minute volume profile will be the low here, where all these other candle lows are at. 39.43, right around in there. At which point it will then look just like we were talking about. When I say when we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. Tomorrow morning, it's going to look like price bounced off the bottom of this area. And I'm pointing that out because I'm continuing to try to show people that this indicator moves through the day, right? As these candles fall off back here, these lines are going to shift. So tomorrow, it's really going to look like price was just perfect and bounced off of that level. And we know that that's not what happened, right? So we'll revisit that tomorrow. The point of control is really, really low compared to our current location, 39.60. As you can see, there's a massive air pocket. There is nothing here to catch the market until at least that weekly gap close that we've been focused on, that 40-30 area. We have to get back at least that far before we run into even a little bit of support or assistance. It shallows up after that until around the 4,000 area. Get a little bit of support there, goes back into shallow, and then we get to the point of control. The main thing is if we start making that kind of move to the downside, these little areas of volume nodes, volume shelves, they won't be enough to catch this market. but they might slow it down enough to get a first touch bounce, right? It's a counter trend bounce, good for, say, 6 to 10 point bounce before it rolls over and continues to go lower. We now have a volume point of control that was developed yesterday, so we need to put that one on. We took this one off from the 40-35 area. So we'll just take this one from down here. It's close enough. So that one just gets added to the list. We now have a couple to the downside, and we still have one overhead, 42.30. There's really nothing else to bring forward, and nothing of value that we can use on any of these. If you look at yesterday's volume profile, you can see there's not going to be anything really of help, right? It's shallow. Even that little bit of support or that little bit of assistance at 40.40, it's not going to be very much, but it's all we got. There is a third possibility that the market just kind of hangs out here for the rest of the week. Right? We talked about a big move up and a big move down, but there's always that third possibility that the market doesn't do anything, just kind of holds the line. We're not outside of the weekly expected move either. So as much as that move may have felt really big last week or yesterday, this was the range for the week that we got last Friday as we went into the close. They said the market could move from the close down to this red line or up to this green line, and it wouldn't even be considered an outsized move. Well, I mean, granted, we made the whole range in one single day, but we're still in the range. We're also above that volume, that VWAP. It's an anchored VWAP from the first of the year. So 4101 is the top of the expected move for the week. And just because we get outside of it doesn't mean anything. We got outside of the bottom earlier this week, right? That didn't change the world. So we could easily get outside the top and come right back in again. Statistically, we close inside of these range more than 80% of the time. So 8 out of 10 times, we should be closing inside this box. But that's in a normal, good, clean market with normal, good, clean trend. And in 2022, that's not the kind of market we're in. And the numbers, if you count back the last 10 weeks, is more like 40-60. 40% of the time we're in the box and 60% of the time we're not. So they're not really good numbers right now. This kind of helps answer the question, have we moved too far too fast? Was yesterday too much? I've seen people automatically trying to short the market yesterday, like, oh, wow, that was a big move. I'm going to buy me some puts. That's a bad idea if we haven't gone far enough, right? If it's that crazy phrase overbought or oversold, or it implies the market's gone too far. It's done too much. We're going to take it the other direction. But you shouldn't do that blindly just because it made a big move. This is an indicator that I built looking at how far away from a moving average we are. And I like to use the 10 as, say, the mean or the middle of the average price, say it that way. And so when we're on the 10 or close to the 10, we're sitting at an average price, our mean or norm. And then how far beyond the 10 we get starts to measure how extreme we are. Every market has a reversal point. It's distance from 10 that it goes to before it starts to turn around and pauses there or turns around and goes back towards the 10. For the ES on the 10-week this year, we have gone farther away than what we did yesterday, but only once. And that went to 5%. We're very close to 4%. And we're way beyond what the average would be. So we're due, if you're looking at the weekly, we're due for a pause here. We're due for some consolidation and or a reversal back to the 10-week. But the 10-week, these numbers change on a week-to-week basis, right? Because that 10-week moving average doesn't adapt as fast as we would want it to. Well, let's swap over to a day. So this is asking the same question: how far away from the 10-day moving average are we? And what's our normal reversal spot? And have we traveled too far, too fast? And the answer is no, not even close. We're 1.9% away from the 10-day moving average. And the typical reversal spot is somewhere above 2, a little above 2. So we haven't even gotten into the point where it would typically reverse. And we're certainly not in the extreme, right? We can see that on the year, the ES has moved 3.6% and nearly 4% away from that 10-period moving average at various times this year. And we're only at a not even 2% move. So it has the capacity to go farther. But we're getting close to that spot where we would start using the phrase, overbought, or that it moved too far, too fast, but not yet. So don't just instinctively run out and buy a bunch of puts. It's very likely, you see this big move we had there, and then we kind of consolidated. It's very likely that we get something like that, but it doesn't have to be that. And that was on a Thursday, right before a Friday. Well, ours was on a Wednesday, so now we've got Thursday and Friday to get through. All right, technology and consumer discretionary are still below that 200-day moving average. And that's a really big deal. They're also descending 200s. So, running into the descending 200 is typically a rejection point. We could overshoot it first, like XLI did back here, where it shot through it and then rolled through. But looking at how everything else is going, it's very likely that we're going to see these markets get above that 200 and join the rest of their sectors. A lot of times you'll find 5 or 6, often 7 out of 9 of the sectors all pulling into a resistance level or all pulling into a support level. And it helps kind of grow a little confidence in the idea that if 7 out of 9 sectors are all coming into resistance, you're very likely going to see resistance hold and reject the market, or going into a support level and see that hold and support the market. We don't have 7 out of 9, but we certainly have, probably a 50-50 of markets that managed to get through that resistance level and are above it or through it, kind of into some clear sky, and it gives them the freedom to kind of move around a bit more. I don't use all my tools, say the distance from 10, and go through every one of these names. I just tend to look at the index itself. But you could, right? You could put it on these different sectors and see if these sectors individually are overbought or oversold by how much, or if they're even near those edges of what we would consider overbought. They talk about a rising tide lifting all boats. It really didn't lift XLE yesterday. We're looking at a green candle, but it's a solid green candle, showing that it closed higher than the previous day's close, but it closed lower than where it opened. That basically is a red day, right? It gapped up and then it closed lower than it opened on a day where everything else ripped like crazy. So a rising tide didn't lift all boats, didn't lift energy or the names that are in energy. These are the names that make up the energy ETF XLE. And if you think about the kind of move that we saw yesterday, it didn't look like these. Right now, ExxonMobil and Chevron, they kind of stand out. Schlumberger, they didn't have that big explosive expansion like the S&P did, but they closed in the upper part of their day near the open or higher than their open, as opposed to a lot of these other names that didn't, right? So this is that condition of the rising tide lifting all boats. Even energy has companies in it. And those companies are a part of the stock market basket that got lifted with all those flows. If we start to flip over and this all begins to unravel, these energy names, very likely the ones that didn't participate are the ones that are likely going to begin to move up. It'll be that capital rotation. Banking got some fire yesterday. All right, KWeb is down this morning 1.3. That's a little bit of a surprise. With that China news, would have expected the KWeb to be up more, or to at least be up, not down. So take a look at that. All right, well, they did have a pretty big gap up yesterday. They're down to 28 this morning in the pre-market, so they faded off a little bit. They're sitting right about there. Now, we don't trade KWeb. We just use this as like an indicator of the money flow out of China, the ADR push, all right? The state banks were ordered to buy a lot of the internet and China stock names. Baba, Baidu, Neo, JD, PDD. Baba's down this morning. It's sitting at 85.5. So it's back inside this box. That means it failed the breakout. Baba's down $1 this morning too, so it's sitting at around 107.8. That's not down much, considering how far it moved yesterday. That's still sitting outside the pivot, but it is a failed bear pennant. And it is a TRB that's still holding. All right, this is down $2. PDD had that big explosive move after that earnings. It's at 80.20, so it's barely above this candle's high. That'll be the structure it needs to hold. Remember, I still think this is a good short after that really big expansive move, but we don't want to short it yet. We want it to roll over first, because when it does fall, it has a lot of room to fall. I'm thinking 60, 50, 40, plenty of room to run this thing back down. So there's no reason to jump the gun and get in early. I started talking about shorting it on 11/28. But I said, wait, don't short it yet. We want to let it actually roll over. If we had started to short it on that day, oh man, we would have gotten run over, right? It went up nearly $10 more since that $75 discussion. So same thing now. I still think it's a good short. Just got to give it a chance to roll over and show us that the short is ready. Then we pounce on it. JD's at 55 this morning. So it's underneath this daily gap level, which got taken out. That's not even a thing anymore. We have new gaps to focus on, but it's not even worth really drawing them out yet. This would be a rejection off of this pivot point from back here, which failed to give us a new higher high. But we still need it to unfold through the day. And it doesn't really make sense that these names are down, right? With the China news that came out this morning, we shouldn't be seeing these names down. Natural gas is up, so we might get a red to green today. That would be having a down day yesterday and then a rally up in the pre-market near or close to where we opened the day before. It's kind of the benchmark, right? The one that I like. If we open above where we opened the day before and then we fade a little bit, we can catch support and we get this beautiful bounce rally. That's the good kind of red to green. Really great follow through. It looks like this back here, right? Only, I guess that's a bad example because we opened above the previous day's open, but then we faded down to the close and then rallied. I guess that kind of makes sense. It closed the gap first and then it ran. Either way, we got a UNG red to green setup possible today. And XLE is up this morning. Just barely, just slightly up. This is looking like a green candle, but it's a solid green candle, which means it actually closed down here. What we want to see this morning is that it gets above where it opened yesterday and maybe proves that that's support for a run, say 93. USO is an inside day breakout, so it's already outside of yesterday's candle. Be careful with this one. Multiple days in a row of gap ups. Apple is basically flat this morning, as is most of the market. So Apple is tangled up where it closed on Friday of last week. It's the resistance that it's fighting through today. I'd be watching that for the reversal, kind of the line in the sand, make or break. If we get above that, we're very likely going to hit 150, and we could get up to this trend line at 151. It's very likely to happen pretty fast. Think about how it moved, say, on Wednesday with that breakout and then the fast run up into that resistance, and then it dumped. Depending on how we close for the week, I've got Microsoft puts. I've had them right for a little while. We're probably going to add some short puts to the puts that I'm holding. That way I can defend my puts without closing them as a loss. But I want to see how it closes on the week, if we close above that 250 or not. I've got plenty of time. There's no reason to rush necessarily. I don't want to sell puts and then get ran over. So I want to really see how this resolves itself for the week. Microsoft is down this morning. Apple's barely up, but Microsoft is down. It's still sitting above that blue line that I just drew. So it is higher than that, but it is down. So that line, we're going to be looking at that as a support level and see whether or not it pulls back to that and validates that Busby or not. If it doesn't, and it continues to move higher, then we're going to be focused on that 270 level. All right, emerging markets is down and KWeb is down. That really doesn't make much sense with the news. Gold is up, silver. So very likely the US dollar Japan is down. Yep. This pair going down often gives, gold and silver that opportunity to go up. And we're getting a continued breakdown in the dollar here. Really solid move below that 105.25. It's kind of that line in the sand from back here. 104, 103. This is going to be a serious level to keep your eye on with the dollar. Most of the big institutions out there are saying that the default automatic buying position, the one-sided buying of the dollar, is basically done. And that now it's getting more into a two-sided marketplace. So it's no longer just some default position. It's hard to argue or to consider that the dollar is still bullish, right? Or that there's any trend left to this in the upside at all. But we had a big breakout of a major resistance area. And now we're just doing a Busby, right? It's what we've talked about before, what a Busby is. When price tests resistance multiple times and then breaks out and pulls back afterwards to test the old resistance as a new support level. So 103 half, 103.75, anything like that is still going to be considered support, and this would still be considered bullish. But it's a hard argument to make right now that we are bullish in the dollar when it looks like this. All right, so it really needs to hold 103 half. We drop below that and get back inside the box, being bullish in the dollar, that's done, right? We would have to see something new before we could resume any kind of bullish thesis after that. And that's possible, right? A trend can die and be dead and then start again in the same direction, begin trending again. So just because a bullish trend dies doesn't mean we have to go bearish. The Q's rallied right into resistance. Needs to resolve this. And so far, we're above that level, but we got to stick it. And the data is coming in right now. It's right where it should have been. U.S. consumer spending month over month was 0.8, and it was forecast to be 0.8. The PCE year over year was 6.0, and it was forecast to be 6.0. And there we go. All right, so we want to watch for a fake out breakout and keep your eye on Fed speakers today, additional auctions through the lunch, and I will see you guys tomorrow.